4 days ago, S&P Global cut Oracle's credit rating to BBB-. That's one single notch above junk status. The agency pointed directly at Oracle's AI infrastructure spending as the cause for the downgrade, but it also pointed to something more specific and more uncomfortable. Roughly half of Oracle's $638 billion backlog of signed future business depends on a single customer, OpenAI. This is the same Oracle we talked about in our last video on the AI bubble, the one that sold $18 billion in bonds in a single day back in September. Back then, we described the financing structure as risky. Now, a major credit rating agency has put a number on that risk and downgraded the company because of it. And Oracle isn't some isolated edge case. According to a June analysis from the research group OpenAI, combined spending on AI infrastructure across the largest tech companies is growing about 70% a year, while the cash those companies bring in from operations is growing only 23% per year. Those two lines cross this quarter. So what exactly happened to Oracle, and why should anyone outside of its shareholders care? Is this a one-company problem, or the first visible domino in something much bigger? And if free cash flow across this entire industry is about to go negative, how exactly are these companies planning to keep the spending going? What does that tell us about how sustainable any of this really is? Let's walk through Oracle first, because the mechanics here are genuinely instructive. S&P's downgrade wasn't really about Oracle running out of money today. It was about the trajectory. The agency expects Oracle's debt-to-leverage ratio to climb into the mid-4 times range by fiscal 2027. Above the 4 times threshold, S&P considers acceptable for a standard BBB rating. Oracle currently carries $167 billion in total debt, and it's planning to raise another $20 billion in equity this year on top of that. Here's the specific vulnerability that pushed this from a lot of debt into a downgrade. OpenAI accounts for roughly half of that $638 billion backlog. If OpenAI runs into its own financing trouble or simply can't meet its side of the contract, Oracle is left holding enormous data center leases it may not be able to exit or refill on anything close to favorable terms. S&P is now projecting Oracle will run a free operating cash flow deficit of nearly $42 billion in fiscal 2027 alone. Oracle's own defense is that most of its debt is structured to avoid near-term pressure. 70% of its borrowings don't come due until after 2030. That buys time. But it also means that if AI revenue doesn't scale the way the company is promising, Oracle will eventually have to refinance around $79 billion in obligations. That refinancing could come at much worse rates than it's paying today. It's less a fire right now and more a very large, very specific bill with the due date pushed a few years down the road. And notably, the market barely blinked. Oracle stock rose slightly the day after the downgrade hit. Worth remembering that, because we'll come back to it. Because Oracle is genuinely not the exception here, it's just the company furthest along a path every major hyperscaler is now on. OpenAI's analysis, built from years of quarterly SEC filings, models exactly when each company's cash capital expenditure overtakes its operating cash flow. Oracle has already crossed that line. Amazon is crossing it right around now. Alphabet is projected to cross around the start of 2027. Meta around the back half of 2027. Microsoft not until sometime in 2028. So this isn't 4 separate stories. It's one story playing out on a staggered timeline, with Oracle simply arriving first because its balance sheet had the least room to begin with. And here's the historical whiplash worth sitting with for a second. From 2010 through 2024, This same group of companies generated $2.7 trillion in operating cash flow combined and spent only 39% of it on capital expenditure. The other 61% went to buybacks and dividends, the very things that made these companies famous as cash machines for investors. That ratio has now flipped, and capital expenditure is projected to eat 90% or more of operating cash flow across the group for the next several years. The companies that used to hand cash back to shareholders are now the ones asking shareholders and lenders for more. So how are they really covering the gap? Three main ways, and all three are worth understanding because they carry different kinds of risk. The first is straightforward debt issuance, just at a pace the sector has never seen before. By mid-March of this year, the top AI capex spenders had already issued more corporate debt than they issued in the entirety of 2025. The five largest hyperscalers now account for more than 15% of all US investment-grade bond issuance so far this year, according to the Bank of England's most recent financial stability report. 15% of an entire country's investment-grade bond market coming from 5 companies building data centers. The second lever is equity. Amazon has told investors directly in an SEC filing that it may need to raise both debt and equity to keep funding its build-out. Oracle has already issued $5 billion in convertible preferred stock and plans $20 billion in equity this year. That dilutes existing shareholders, but it doesn't carry the same default risk that debt does. That's part of why some analysts see the shift toward equity as these companies quietly protecting their credit ratings while they still can. The third lever is the one we spent the most time on in our last video: off-balance sheet financing through private credit joint ventures and special purpose vehicles, the kind of structure behind Meta's $30 billion Hyperion data center deal with Blue Owl Capital. These arrangements let a company avoid showing the full debt load on its own balance sheet, even though the economic obligation is real either way. Here's the genuinely important question underneath all three of these levers. Is this a temporary, manageable phase of an otherwise sound investment cycle? Or is it the early architecture of something that looks a lot more fragile the longer it goes on? There's a real credible argument for the calmer read. Research from Allianz found that even with debt issuance accelerating sharply this year, the current leverage ratios at these companies sit roughly 20% below where the highest spending firms were at the actual peak of the dot-com bubble in 2000. In other words, by this specific measure, we're not yet at 2000 level extremes. That's a meaningful data point, and it would be unfair to pretend otherwise. But two things make this moment harder to wave off than the comparison suggests. First, regulators keep sounding the alarm anyway. The Bank of England's July Financial Stability Report specifically flagged declining free cash flow at these firms as a risk worth tracking. The Bank for International Settlements has gone further, warning of what one summary of their research called a danger like 2008. Second, and this is the part that should worry you more than the leverage ratio itself, this isn't spread evenly. It's concentrated. Oracle's entire growth story rests heavily on one customer's ability to pay. A huge share of the demand underpinning this whole capex boom runs through a small number of interlocking companies. They're buying from and investing in each other in ways that can make genuine external demand hard to separate from demand that these companies are effectively manufacturing among themselves. We covered that circular financing pattern in detail in our last video, which brings us back to the market's strange non-reaction. Oracle got downgraded to one step above junk, and its stock went up. That can be read in two ways, and honestly, nobody knows for certain which one is right just yet. One read is that equity investors are looking straight through the credit signal to Oracle's enormous, genuinely real $638 billion backlog. They're betting the revenue eventually shows up, regardless of how it's financed in the meantime. The other read is less comfortable. It's that the bond market is simply one step ahead of the stock market here, and equity investors haven't caught up yet to a risk that's already showing up in credit spreads. Those two readings can't both be true forever. At some point, either the AI revenue materializes fast enough to justify the spending, or the debt and equity markets start pricing this the way the credit rating agencies have. If it's the second scenario, the consequences don't stay contained to Oracle's shareholders. We've already walked through, in our earlier videos, exactly who ends up holding this kind of risk when it's financed through debt and private credit rather than retained earnings. That list includes pension funds, insurers, and increasingly, ordinary retirement accounts that picked up exposure to this sector without anyone explicitly choosing to bet on it. Oracle's $79 billion in obligations that eventually need refinancing isn't an abstract balance sheet line. It's a bill that has to get paid by somebody on some timeline, regardless of whether the AI revenue behind it arrives on schedule. None of this means the AI infrastructure being built right now is worthless, and it would be dishonest to suggest otherwise. Data centers, power generation, and networking capacity, all built during this boom, will likely still be useful for years, in the same way fiber optic cable outlived the dot-com companies that financed them. But the honest way to think about this moment isn't AI bubble yes or no. It's narrower and more useful than that. Free cash flow across the industry's biggest spenders is genuinely heading towards zero this quarter, on a staggered timeline, company by company. Oracle just became the first of them to have a major credit agency put a formal downgrade behind that math. Whether that turns out to be an isolated warning shot or the start of a wider repricing depends entirely on something nobody can currently prove either way. Whether AI revenue scales fast enough, soon enough, to catch up with what's already been spent. We've covered two closely related sides of this story already. One is our video on why AI is a bubble in the first place. The other is our video on layoffs several of these same companies have made to help fund this exact spending. Thanks for watching. Goodbye.